about 18 years, I worked in the exchange and LMM ETF specialist group at Goldman Sachs, where I
You killed it.
I killed it. Worked on exchange liquidity providing, so this is a subject that is really kind of near and dear to my heart. I'll take a moment and let the rest of our panelists introduce themselves.
Thank you, Andrew. I'm Naomi DePina from GTS. I'm joined by a few of my colleagues in the room. GTS, we're a market-making firm in New York. We are one of the largest market-making firms currently in the top 4 of ETF listings, lead market maker to a number of products that we help support ETC with, actually. I work in our ETF sales department doing ETF sales and trading, mainly focusing on issuer relationships and outsourced trading.
Hi, my name is Brian Moore. I'm with Barron Capital Group, just right down the way there. I'm the head of capital markets. Joined Barron in January of this year, shortly after our initial launch of 5 ETFs in December. We're up to 7 now. And really, I work with the PMs, work with the trading community, and Naomi and others.
Hi, I'm Joyce Rosalie. So I'm at Market Access, and I run a quote platform, request for quote, RFQ Hub. RFQ Hub actually was a standalone platform, and it got lifted out, and Market Access bought it to move into the equity and ETF space. The majority of our volume currently in Europe is 99% of it is derivatives based, and in the US it's ETFs and ADRs. That will be changing over the next couple of months to a year, and we'll be flip-flopping that, so we'll be able to cover all those products. I started my career as a trader for 10 to 15 years between Goldman Sachs and Deutsche Bank. Then I can move into the sales space and the ETF space as well. So I'm super excited to be here with some of my colleagues because I work with all of these guys.
So to kind of kick off the discussion here, one of the things that the most topical thing that comes to mind with ETFs is just the sheer number of products that have been issued, the inflows, over 1,000 funds last year. This year is on pace to meet or exceed that. I think $1.5 trillion of inflows. Just given the proliferation of the number of funds, how does this affect the ability to provide liquidity in that number of funds? What are the constraints on LMMs, the constraints on balance sheet, constraints on staffing? Does the system have the ability to provide liquidity just given the number of funds that have been issued? Brian, what are your thoughts on that?
I think it's becoming more challenging, without a doubt. I think it's one of the things that market makers are having to rely more and more on automation to kind of keep up with the pace. Balance sheet constraints, as you mentioned, are also something that kind of gets tight around index rebalancing periods as well. But it's one of the things that we're starting to see newer, smaller entrants into the market making space, which is promising. I still don't know if that actually alleviates kind of the congestion at the top, say, 4 or 5 market makers.
So what else is going on to really kind of mitigate the proliferation, the number of funds that we're seeing, Naomi?
Yeah, and just to add to Brian's point, we welcome other market makers to this space. I think that we're all in a very competitive, and someone mentioned this on an earlier panel, where the ETF space is very collegiate. We all know each other. We all work in some degree with each other, right? However, there's this sense of, in the market making community, that we do welcome more entrants because more can be involved in your ETF, therefore hopefully quoting tighter spreads in the product and just having some activity there. To give some color, Andrew, into what you were saying earlier, I think the spike in new launches is really something we should draw attention to. So last year, we had about 1,100 new ETFs launch in 2025. This year, in the first 5 months, we were over 450 ETFs already. So we are more than on track to hit 1,100 plus ETFs launching this year. At GTS, we've felt the pressure of this, and we'll talk a little bit more about constraints and balance sheet, the stress on that. But to think about it in a way where, are we nervous or are we worried about the quality that we're going to provide our other LMMs because of the spike of launches? My answer is no, and we'll probably get into that more on the panel.
Yeah, I would just add to that. We see that as a platform that welcomes market makers onto our platform. People always ask me if I was looking for more market makers. We always feel the more the merrier, right? If there's more market makers, there's going to be more competitive. That means the end pricing is going to be better for that end investor when it comes to trading, because trading really is a huge part of owning an ETF. So I really think it's important to see a lot of these newer firms are popping up to become market makers in the space. As an example, my former firm, Goldman Sachs, moved out of that space. They moved out of that space for a number of years. Guess what? 6 months ago, they decided to jump back in that space. And why? Because there's a need out there for it, and they see a opportunity to help the ecosystem and to actually make it better. So I think because there's more ETFs out there, there's more need for more market makers. And again, welcome them into the marketplace because it'll just make the ecosystem stronger.
So I heard the word automation earlier, and to give a little story from my past, when I started in ETFs, SPY was trading on the floor of the Amex. To trade SPY, it required about 4 to 6 people, right? Somebody was on a wire with Chicago, somebody was keeping track of the book, somebody was interacting with the crowd, right? That was just for one single ETF. By the time I left Goldman Sachs in 2018, we had a desk of 4 or 5 people that was trading electronically 700 funds, right? So automation has been critical in the growth of ETFs and the number of funds that are issued. It's really something that's no longer an option. Would you say that's the case, Naomi?
It's table stakes, I would say. Yes, 100%. So automation, personally, in my personal life, I suck at it, right? So I don't know how to automate things in my house. Alexa is my best friend because of that. However, when you think about working on a trading desk and you think about working with a number of issuers, there's a relationship for a market maker where it's the issuer and the market maker. The lines need to connect. We need to talk to each other through those lines of connectivity because human error, there's a higher chance of human error. Automation also makes it more seamless in terms of create redeem baskets and also mitigating the amount of risk that we have. So it's table stakes at this point, especially as we get into more complex products. We see a lot of option strategies, buffer strategies, and the more complex the ETF is, automation is really key there to support the issuer.
Yeah, I mean, I would jump in there as an electronic trading platform. We're actually automating our electronic trading platform, right? So now we're at a different place where someone wants to use our platform, but they want it all, they want the execution, they want the decision to trade or not trade, they want a minimum number of brokers that they are going to ask for with regards to whether or not it should trade. And on the flip side of that, the market makers that are on the platform, if they don't auto quote and they don't come back, they are not competitive. It's just not even a question now. So it's challenging for some of the banks that have not actually invested in this and have not they can't auto quote, so they can't be on our platform. They can be on it, they're never going to win. I tell them not to waste their time. If you can't auto quote an ETF, don't bother being on an RFQ platform. It's just, just a frank reality. So I think that's really important. We're working with a couple of partners right now. MarketAxess also bought Pragma, which was an algo provider, and we are leveraging their technology. If you want to come through Pragma and hit RFQ Hub, you can do that. And we've also partnered with another piece of technology as well, Optimix, who is also all about optimization of sweeping blotters, getting ETF orders to be automatically executed. So if you don't find ways to automate your execution, you kind of get left by the wayside.
I think you brought up a good point there. There's two really types of trading that I view, kind of more retail oriented and definitely more the block style. The RFQ style lends itself very well to block style. But you're starting to see that emergence between the two groups, which I find really interesting, and it really relies back heavily on the automation that a lot of these banks have actually been developing, which underpins all that is data.
So are there any areas where you think that automation is lagging, where there's still gaps that need to be filled? Naomi?
Personally, no. I think that where Joyce is making a comment in terms of auto quoting, that's huge. And where it can be a little bit more manual, and just for full transparency, on our desk, 3 or 4 years ago, we started to make a significant investment in engineers, right? And so these are amazing comp sci people, and probably we've hired since then 14 people just in that space, because it was critical that, when I work a lot in the ETF strategist community and the TAMP community, and when they would say, hey, we hit you guys on RFQ and you had a no quote. Embarrassing, right? And so I would go back to the desk and ask, well, why is this, right? And we would then, one thing that's pretty manual is going back to those firms and saying, well, what's in your typical rotation or what's in your models? And maybe we can start by adding that to our auto quoter. So not being able to auto quote the entire universe, because we all know how many ETFs are out there, but being more specialized and focused, that's pretty manual, but it does, I never want to take away my job as a salesperson to get that information for our desk.
Yeah, I mean, I would agree. You don't have to be the best in everything.
Right.
And I think that's okay. We get asked that question a lot by clients. So if I were to, quote a fixed income ETF, who should I put in my rotation? Who should I put in my pool? And I always say it depends on the day. Any given day. That's the beauty of RFQ, if you think about it. You're basically getting the look into everyone's book on a daily basis, and their book changes. They get hit on the other side on something, all of a sudden, guess what? They're the most aggressive person in that ETF on that day, in that moment. It can change even hour to hour. So I always say, like, yes, we can pull out statistics. Yes, we can say, okay, who is the best in commodity ETFs? But again, if you limit yourself to just certain amount of market makers, you're actually limiting potentially better price improvement. So I always say that it just depends on the day, but that's kind of the beauty of it.
I would agree. I mean, I think competition brings out the best in everybody in this business. So I think you do want as many of those people. Plus, a lot of the smaller firms that market-making firms that I'm finding out are really starting with kind of, I don't want to say niche industries, but definitely they're kind of going, okay, where's our core competency? Let's build on that. And so as they get more active and get on RFQ Hub, I think you're going to see even more competition from the other big players.
And I would add one thing in here, because I do agree with you both to a certain extent, but I also slightly disagree. Because I think where we have, when you want to include, going out and communicating, we have a firm that goes out and communicates with 3 or 4 market makers to get indicative spreads or indicative quotes. And I think that makes more sense than going out to 8 or 9, because there is a portion of information leakage that you don't want the whole street to know what you're trading. And if you are putting, let's say, 9 people in competition on RFQ, that puts what you're doing and your bread and butter a little bit at risk, because the whole street will know what you're trading. So I agree that competition is great, but I also agree to be a little bit more focused when competing.
I would agree with that, but I do think a lot of times if you're doing one block, then it's okay to do it in one shot. But you're right, if you're going to be a repeat buyer throughout the day, you got models,
Right.
you got multiple TAMPs, it definitely can tip off the street.
Also, always depends on the product.
Correct, yes.
Yeah, I mean, I think that's an important point, especially about the information leakage. It's something that we think about and we worry about from an issuer side when we're trading for the funds ourselves. I mean, obviously, I don't think it's any great secret when I say that there are a number of strategists out there that try to anticipate ETF changes. They anticipate index changes. They anticipate model changes, right? So
We used to call that the Russell rebalance.
yes. So I think that's a great and important point. Kind of turning to market maker dynamics. I've been on the LMM side. I'm now on the issuer side. What are your guys' thoughts in terms of how issuers work with the broader market making community, right? I mean, you want to have a number of market makers that you work with. How important is LMM, but also having other market makers involved in your product as well?
Yeah, I think the relationship is critical. Sometimes we, with white label firms, Andrew, such as your firm, right? We can hear from you and Todd and say, okay, well, would you guys be interested in market making this product? One thing that you guys do a great job of is connecting us to the end issuer to have a conversation and have a real relationship. The relationship part of this is critical, and a lot of people think this is just an automated business. Our commitment is technically to the exchange, right? But our commitment is also, if we know the issuer, we want to have that relationship, because if you have an advisor trading in your product and we're aware, we can go back to our desk and say, hey guys, can we tighten the spread? So over communication is key. That is manual. I don't think it'll ever be automated. And that's one part of it. But having just a relationship with your market maker is the first layer. I think as you think about just depending on your lead market maker is a false expectation or a false way of going about it. Developing other relationships with market makers, don't worry, you're not cheating on your LMM. Having those relationships is critical because we don't want to be the only one quoting your product. If we're the only one quoting your product and we're getting the blame game every time, that's rough because having more activity is going to do your end investors a service.
Completely agree. And thank God you just told me I wasn't cheating on you.
Yeah, you're not.
No, I liken it to almost being at a grocery store. I think if you want your product front and center, it really takes work, whether you're talking to the grocery store or whether you're talking to the marketplace. And so it really is about, I think that's one of the things that I like about the capital markets role. I cover Naomi just like she covers me. I view her as my client. I view GTS as my client. And it's one of those things that is a relationship business. And I think that's the bridge that helps get everything going, and that there's a certain trust there between both of us that say, okay, you're going to have your files out there on time. They're going to be correct. If something major happens, you're going to tell me. And that's one of the things that I think a lot of newer entrants in the business really are starting to learn.
Yeah, I think I did a short little stint when a company was basically deciding if they were going to move from the mutual fund only space into the ETF space, which I think we've all seen across the ecosystem. All these large, long-only asset managers that 15 years ago said, not me, not ETFs, are now all in the space, right? And watching some of these PMs that were traditional mutual fund PMs move into the ETF space, it's an education. They need to learn. And the biggest part they have to learn is how important the capital markets portion and the market makers are to the ETF ecosystem. They don't have that in the mutual fund space. They don't understand how important it is to the success of your product. And that means not just your LMN, but all the other market makers that are actually involved in the product. Because if your spreads are not tight in your ETF, guess what? No one is going to buy it. And that means there is no AUM in that product by the end of the first year or first 2 years. And that leads to, obviously, an unsuccessful product. It is a key part to the entire ETF wrapper is actually embracing the capital markets and the market making community, not just your LMN, because you can't have one LMN. And I think I've seen people fail by only using one LMN. I worked at a place that did that, and they needed to actually broaden their relationships. So I think it's really, really important.
And Joyce, that's a great point because a lot of firms that we come across are planning to launch an ETF without a capital markets person in that seat, right? And so maybe a lot of these people have mutual fund backgrounds, but regardless of that being said, it's critical. Another point to that as we're seeing new entrants in this space is thinking about the relationship that they have with these other firms. Let's say we're working and we're your market maker. If you have a relationship because our quoter is down that morning and you call Jane Street or Virtue or Citadel, we're not offended. We're actually relieved because we want to be there for you. But we're all human, and all of our quoters, all machines go down at certain points, not just us. It happens to everyone, and it's great to have a backup in this space.
We've been using a term here, and I'm going to get on my soapbox for a second. We use this term. Everyone in the ETF industry we understand the shorthand, right? What is ETF capital markets? But if everyone in this room is not in the industry already, we get people from the mutual fund complexes. We get people who are advisors who want to launch a fund. They run SMAs. They don't understand what capital markets is. They're like, what is this? And we've sussed out a definition here. I have a very simple definition, which is it's basically everything that needs to happen to have smooth secondary market trading in your fund, right? And I mean, it's how do the baskets come out? How does the creation redemption process work? Are there any kind of quirks? What are the fees? What are the costs involved? If someone doesn't understand what capital markets is, how do you guys define it to them?
I like to refer to as kind of basically the hub on a wagon wheel. I think everything flows through me, and without me, things can still get to the other side, but it doesn't mean they're going to do it in the right manner. And I think you're 100% right. I view my job as customer service. I'll service the trading community. I'll service the PMs. But I'll also be the conduit to say, no, you can't actually say that to the market makers. You need to do this. And then it becomes an educational process. Well, why do I need to do this? And so those are one of the things. But at the end of the day, you're really putting your funds or your ETF's best foot forward to become successful. I think we all are seeing a lot of things launch. Who knows how many will actually be successful, but there's a better chance if you can actually get the market makers comfortable with you, get the RFQ hubs comfortable with you, And that way the trading community can go, okay, we're going to make it as tight a market as we want, as we can in this product.
So, continuing with the market maker theme, when you think about all these various execution venues, whether it's RFQ, whether it's algos going directly to the exchange, whether it's working with a single individual market maker, how do I think about choosing among all those options, Joyce?
I always say time and a place, right? There are all these tools out there. RFQ is just one more tool for you. Algorithms, I sold algorithms, another tool for you. Or there's a time to pick up the phone and call Naomi and say, I need to do this trade. And I want to make sure I'm doing it the right way and I'm making sure that I'm getting the best pricing on this. So time and a place, and that is actually what a trader's expertise is. Knowing when to use what tool, when, actually makes you a good trader. Not because you actually have this feel for the market or anything along those. Knowing how to use your tools is actually super important to the whole process. And I think knowing that and knowing that they're all out there and they continue to improve. Like I said, workflow is super important. And when that comes, that brings us back to automation. So if there's a time you're a super busy trader, you're multi-asset right now. Most people are not just trading equities. They're not just trading derivatives products. They're trading multiple products. They're trading bonds too. It depends on what kind of fund you are. So that being said, if you had a tool to come in there and scrape all my ETF orders and send them out to the marketplace and send them through RFQ, that makes a lot of sense. So that's what our job is providing these solutions to make your workflow better. And I think that's the most important part of kind of the ecosystem is learning that as a trader.
Completely agree. I mean, I think that's also one of the things that it's really kind of a good telltale that somebody is experienced and knows what to do and is a good trader. I mean, I think there are times people always ask when you're talking to clients, I'm like, call your custodial desk, call your market maker. Do you have a relationship? And they're like, why would I want to do that? And the one thing I tell them is, if I gave you $1,000 for 1 minute of your time, would you do it? Well, yeah, of course. Well, you're going to save $1,000 if you go directly to the market maker or directly to your custodial trading desk, which dovetails in very nice with what Joyce was saying. I think it really is, there's a plethora of tools out there, and it's really up to the issuer to really kind of help guide their clients into how to best use them.
And I think being educated on expanding that toolbox is really important, because a lot of times, some issuers and some clients, Joyce, that have maybe never used an RFQ system before, your team's going out and talking to them and educating them. And that's really important for people to be more open-minded and actually see the benefits and ask around. I also think when you're expanding your toolbox a bit, it's important to say, I am a deal hunter. I love to shop for deals. But it is important to see, okay, where am I getting the best deal? Let's just think about when Schwab was trying to impose the fee on advisors to use RFQ. We all collectively as an industry, especially issuers in the room, the large ones, Schwab, BlackRock, Vanguard, did slap back on this and say, actually, we want to be able to use this, and our advisors and our clients should be able to use RFQ and not be charged a per account $5 fee, I believe it was. That was pushed out till June, and now we're seeing that it's pushed out even further and may come out in a different form. So collectively, we see what happens when a tool is being taken away from someone's toolbox and how voices can be heard to bring that back.
So moving on to another subject that's kind of a hot button in ETFs, 351 conversions. We, as a white label issuer, we have had firms and advisors come to us, and they don't really care that much about the secondary market liquidity, right? They want to create the ETF. It's for their own holding. Maybe they use it in client portfolios, and they're not that concerned about liquidity in the secondary market. Naomi, what are your thoughts about 351 conversions and about liquidity in the secondary market?
So we've done a number of 351 conversions, especially even thinking about last year going into this year, quite a bit of requests. As a market maker, we like to see that a fund is launching with assets. We are more keen on taking on that ETF to know that it's already going to have assets in there. coming from my sales background, Joyce and I actually worked together for a period of time at State Street. And one thing that was really ingrained in us was thinking about how can we get ETFs available on various platforms. And I'm not talking about the sectors or SPY. You can sell that with your eyes closed. But thinking more so about the more nuanced ETFs, how do you get platform approval? Where these conversions and 351 conversions actually really matter is having the 50, 100 million, 300 million, and the track record available to get approval, let's say on Raymond James or whatever, Morgan Stanley, whatever platform you're looking to seek at that time. That's where a 351 is important. When it comes to trading and liquidity, just having assets in your ETF doesn't mean that you have a super liquid ETF. Yes, an ETF is as liquid as its underlying, but if there's no volume in the product, all you really did was you launched an ETF with assets in it. It doesn't mean the work of trying to gather volume in the initial 3 months goes away. And that's actually something platforms are becoming smarter about and asking, do you have volume in your product? How does it trade? Can my advisors trade this? Can get in and out seamlessly? And so I really urge people not just to think about 351, I have immediate assets, it's go time, but can I gather up some volume in the product?
Yeah, I still think you need a plan around that, right? You can launch, you can convert something to an ETF, but if you still don't have a plan to make it broadly accessible to the public or a plan to market it, Naomi's right. Trust me, I've had funds that I've had with GTS that after about a year and a half, they're like, hello, what are you guys doing? And you're like, I'm trying over here, you know. But it's one of the things that I think you're starting to see, hopefully less and less of that, because I think the ETF general education is becoming higher. But it's an initial, I think, soft fix for a much longer problem.
Yeah, I mean, I think I was watching, it was on it was the distribution panel that I actually watched downstairs that said, it talked a lot about having this plan. Having assets in your ETF just checks one of the boxes, right? It's just a single box. You need multiple boxes to be checked for that ETF to be successful. And I think that's really important to notice that. And again, a lot of these people that are experts in distribution, I think is really important to lean on them and to use them as a resource, because that's just one box to check for the most part.
Turning to the complexity of ETFs, so the 1,100 funds that were issued last year, many of these are using more and more complex strategies. Some of them are using options. I know there was an options ETF panel earlier, which I've spoken on in the past. What are some of the challenges for these more complex funds for market makers, Naomi?
That's a great question. And so I think the key theme that I'm seeing this year on many panels is complexity, right? So a lot of ETFs are launching and it's becoming more and more complex with options. There's listed, there's flex options, understanding the liquidity profiles and how to seek liquidity in both. It's something that most advisors don't know about. I spoke on a panel a few weeks ago in Boston. I asked, how many of you know the difference between a listed and a flex option? 2 people raised their hand in a room of 100. So it's really, number one, important to educate the end client on the difference here. Another thing that people have to understand in terms of spread quality and execution quality as well is understanding the basket and the options that are in there. For a market maker, we need to hedge in 2 different areas here. It's not simple. It's more complex for the market maker, which comes back to automation being a key component, having that between the issuer, the exchange, and the market maker. We have Bill O'Keefe here, Mr. Flex Options, and so we've sought help a lot from exchanges, and GTS in the past year has put a really big effort into the option space, both listed and flex, offering flex and agency component, and some of our people in the room, Dave here, Manik, are here to talk about that as well.
Yeah, it's interesting. It's opened up for us. It's opened up a whole new world of clients. Our market makers have now become our clients because they have to trade the option as their hedge for that ETF. So not only do you trade your ETF on our platform, but you can trade options, futures, flex options on RFQ Hub as well. And so therefore, again, the world just gets smaller. So it's another tool for our market makers to actually execute those underliers. But I think it's super important. I think Naomi touched on it. Education, education, education. I mean, ETFs are a wonderful tool for the everyday investor, but do they know what's in that ETF? Do they know what's going on? I mean, I remember, when people were like, fixed income ETFs were the new coming, right? That was being very complex because there's bonds in the underlying ETF. But the truth is, it's also lends to liquidity in those underliers. So eventually, I think, when we went from just equity ETFs to fixed income to ETFs, you really see the liquidity actually increases in the underliers, and that's happening in the option space as well, which I think is a really important part. I think the first time we really saw it was when the bond markets close early, the day before every 3-day weekend. If anybody is, worked in the equity space and on the fixed income people already get to leave and we get to sit there, you actually see the fact that the ETF, the fixed income ETFs, there's more liquidity in those underlying bonds because the ETF is trading, and you're seeing the same thing in the option space as well. When you get into the leveraged, ETF space, that's when it gets even more complicated. And again, I think it's all about educating the underlying investor.
I completely agree. I mean, I think there's numerous points back over ETF's history. Volmageddon, it comes to mind initially. I think a lot of people are buying things or being sold things that they don't necessarily know how they operate internally. And so the more complex ETFs get, I think our job becomes even more important in really trying to work with everybody and educate them. Okay, here's how this works. Doesn't mean it's going to go up forever. It doesn't mean it's going to go down forever. They're all different, phase 2 effects to each thing. So,
and I also think too, going back to the education point as well, it's also educating the issuers on the bid-ask spread and expectations that they should have on the market maker as these products are more complex. As I mentioned with options, we have to hedge in multiple areas. When you have leverage products too, it even gets more complex, as Joyce mentioned. So to have a realistic understanding and expectation of what your market maker should be quoting you as a spread is really helpful. And I urge you to have the conversation with multiple market makers to understand that the more complex your product is, you're probably going to see that baked in because we have to pay for that in some way.
Can't wait for those prediction market ETFs.
So as we think about that and we think about the complexity, is there anything that really doesn't belong in an ETF, right? I mean, there's certain broad guidelines, right, with regards to illiquid assets and limitations on illiquid assets. But are there some things that, is there something, crypto, private credit, are there any things that don't belong in an ETF, or do you think that this is kind of like, as Joyce mentioned, there's a certain tail wagging the dog effect where the ETF itself helps with price discovery and less liquid assets?
I think it definitely helps with price discovery. I mean, Joyce hit the nail on the head. When you would see, I even go back to, say, around the great financial crisis when fixed income ETFs started going, you started to see the bond volumes pick up. And even when the bond traders weren't there. One of the things that kind of gets me, though, is you do get to a point, I think, where I kind of worry about more on the market maker side. Things are getting so complex nowadays that what point do we kind of jump the shark and all of a sudden the bid offer spread becomes so wide that it's just not worth actually having that product out there. So it's one of those things. I think, why do we create ETFs as an issuer? We're anticipating client demand, and so I think that process is always going to be a tug of war between the two of us. And Naomi and GTS are stuck in the middle.
Yeah, and I think we're pretty used to being stuck in the middle on this. Andrew, going back to your question, do I think that if there are certain products or certain asset classes that don't belong in ETF? Not necessarily. We've seen a stretch even to when we think about private assets and the private space, right? Two very contradictory themes, right? You're supposed to have transparency, intraday liquidity, all of this. The ETF is the complete opposite of what privates actually offer investors. So when we're seeing the intersection of that, and we've seen firms do that successfully, like State Street has done that successfully, it really shakes up my theories on do these asset classes not belong in ETF, because we have seen it be done well. I think as we move forward into a big world of tokenization is another hot topic we keep talking about. That's very interesting to kind of see in the next year or two how that pans out. We've seen some success stories, but seeing how that works out there.
Yeah, I don't think there is necessarily any asset that doesn't. Again, it's giving people access to potentially to assets that they might not have had access to before. So that retail, that investor, that end investor actually has access to only only institutional investors had. So again, as long as it's regulated, and I think another panel discussed this, the underlyings are regulated, I think you're in an okay space. And I think that's where the prediction markets come into play. I mean, how long did it take for a crypto ETF to launch? And it was not until somebody was, quote unquote, regulating the underliers. So I think that's an important factor.
And Joyce, also, when Joyce was mentioning earlier, and Andrew eloquently called it the tail wagging the dog, right? I do want to make a note that there is a perception that could be a bit false, right? When we see liquidity, the ETF being more liquid than the underlying, it's only for a certain period of time, and then the truth comes out, okay? So there's this notion that, yes, ETFs are such a great vehicle because it makes it more liquid. ETF is just the wrapper, right? Eventually, you're going to see the illiquidity in the underlying. So I always caution people when they say, well, look at what happened in the bond market in 2020 and look at the NABs. And I'm like, yeah, but exactly, the truth did come out eventually. So just be cautious when you're talking to your clients about that, because that goes back to the education piece there.
I mean, I think, not to pick on a specific area, but I think senior loan ETFs are one that when that market gets white hot, really it's only the banks that start being able to kind of create and redeem it. So you start seeing, it's interesting because when the things start to get more volatile, the spreads start going wider, the market maker participation rates fall through the floor, and you're seeing the banks have to actually backstop everything. And so, once everything smooths back out, then everybody kind of comes back in. So it's an area, like Neil said, you have to kind of, again, know what you own, I think.
You mentioned tokenization, and it got me thinking about something. The core market hours, 9:30 to 4 p.m., it's pretty well understood. But we've seen there's more trading outside of the core hours. More exchanges and more venues are offering the ability to trade outside of the core hours. You're seeing more overseas investors come in and interact with U.S. ETFs outside of the core hours. What are your thoughts on some of the trends there?
Well, I don't like working outside of the core hours, first of all. But I think Victor mentioned this earlier in thinking about SIBO. SIBO has expanded the hours there and just being more available depending on the asset class, depending on the country. Our desk is available also to trade Asia. And so hours, right, is one thing. But as we're expanding the complexity and the different asset classes that we're involving within an ETF wrapper, exchanges and us trading through some of those hours is going to be what's table stakes and necessary going forward.
Yeah, I think it was the first panel this morning on market structure where they spoke about trading, 24/7 type of thing. I am concerned about it to some extent because is that real price discovery outside of the hours? And in some of those underlying assets, it might not be. What's interesting, and this goes back to automation a little bit, some of the things that we're being asked globally from other regions is time release orders. That's a very big part of automation right now. So if you have your Asia desk and you don't want to have that overnight desk and you want those time release orders to come into the US market, that's something that's being asked upon from a lot of different clients. And I think it's going to be important going forward. Time release orders really scare me, I have to be completely honest, because if something goes wrong, who's there watching it? Who's there monitoring it? But I think it's going to be something we're going to have to address. But if you're trading in the middle of the night and these underliers are not trading as you're doing that, is that really the right price that's trading at? I think that's what we have to start to ask ourselves.
Yeah, and as somebody who has an ETF, that there's mornings before I get into the desk, I'll look on Bloomberg and I traded 50,000 shares, but the bid for spread's 30 cents wide. It's one of those things, like the former trader in me cringes when people do that. I understand you want that. I'm with Joyce, I don't think it's price discovery. I think it is market makers who are being very opportunistic. I'm not faulting them because there's demand there. But it's something that I would highly suggest that they talk to their trading desk. They talk to somebody before you're out there making markets in it, because it's kind of like Vegas at that point. You're not going to win as the retail trader.
Yeah, I mean, I think you make an important point about automation as well. There's a lot of automation, but there's still, at this point, a need for some human touch and some human oversight, right?
Completely agree.
I hope so.
I think we all do.
So kind of thinking about, are there any, thinking back to the earlier topics, to automation, to product complexity, are there any areas that you think that advisors who are using ETFs should be treading carefully?
That's an interesting one. I think anytime something new comes out, not to pick on private credit, but private credit might be one. I think it's something that unless you're really in tune with kind of how the funds are created, how they're being priced, and you're very familiar with the underlying concept that they were constructed around, I think it's something that it's a good idea to sit back and watch and see how the market prices it efficiently eventually. So I think it's one of those things. The market will always come to a price, especially during the day hours. Sorry, not overnight, but it's and there's nothing wrong with waiting and not buying the first ETF that comes out 2 times X on SpaceX, or something else.
I think a lot of, so I used to I was a wholesaler to advisors in the Northeast, and the amount of times that you go into an advisor's office and you're a little bit shocked of like, oh my God, you manage money, that's not a great feeling, right? And taking a step back, like I joke about it, but it's true, like we've all had these moments. And so if we think about, one thing that I say to advisors is something that shouldn't be in your client's portfolio that you don't understand, right? If you don't have a full grasp and you don't know the issuer and you can't call up Brian to say, all right, well, I want to talk about this Barron product and I want you to give me the rundown, and you can call that person if you don't understand it and then tell that to your client, you should not own this product. Andrew said it multiple times, we are getting more and more complex in our offerings and the listings. Thinking about last year, 1,100 listings, and then most of the fixed income listings, 70% of those listings were active ETFs. And so when it's an active strategy, are you able to explain that strategy versus just showing your client an index? And so having more education, I think it goes back to that. But do I think there are certain things that are not applicable in a portfolio? Not necessarily, because every client's need is different. It's just getting a better grasp of it.
Yeah, I'll go back to what this panel is about. I think we talked about its liquidity. And I have to always bring this back up because Naomi and I had this drilled in our head when we worked at State Street, like total cost of ownership of an ETF. It is a real saying and is really something that you should think about. And part of that is trading and liquidity. So how are you getting in and out of that ETF? It's not just what the underlying expense ratio is. It's what is it actually costing you to be in that product or out of that product. And I think that's where liquidity, which is what this panel is all about, comes in. So I think it's really important to kind of bring it all full circle back to that, is how liquid and do you need to be, and what does that mean to you?
To touch on that, I can't tell you how many times I've been on a call with one of our wholesalers, and the client, sitting across from or sitting on the phone as well, goes, yeah, you'll help me get into a product, but you won't help me get out of it. And I think every time they say that, I'm like, the market makers don't work for me. They're like toll takers. They just want you to trade, and if they match with you, and they hope they do, then they'll take their small slice and be able to facilitate that trade. But to what Joyce said, and even what Naomi said, I think it's really about the issuer community, letting everybody know what's in these funds, how do they operate, and here's how you can actually feel comfortable with putting it in your client's portfolio.
And I would just add to that, expose the advisors to some of the market makers. I think a lot of people think we may not, a lot of people think we may not want to speak to the end advisor. Happy to, at any point, speak to the advisor on just getting them to understand just the entry and the exit, understanding your round trip ticket here, and also being a liaison to help support the issuer in speaking with their clients.
Well, as we have a few more minutes on the clock here, I just wanted to open up. Are there any members of the audience that have any questions for any of our panelists?
You just want to go to drink.
I think everyone just wants a drink.
All right. Well, hopefully we have helped connect some of the dots for you here today. the role of an LMM, the role of capital markets, how that all fits in the liquidity picture. Do each of our panelists have some closing remarks they'd like to make? Start with you, Naomi.
Thank you. So I think that as we go into the next half of this year, it's really important for us to think about and keep an eye on the amount of new launches. GTS, when I started, we were at a couple hundred ETFs. We are quickly approaching this month about 700, and I think before the end of the year, we'll have 1,000 lead market making commitments. So that just speaks to you. It's not that, our team is amazing. I know we are amazing. However, it is probably the same case for many of my competitors in the room, that the spike of launches is there. But with that, the importance in communication and customer service doesn't go away, as Brian mentioned. So over communication and working with different platforms and different technologies like Joyce, it is really important.
Yeah, I want to touch back to something that Naomi mentioned regarding Schwab and kind of putting the fees on. Not only did the issuers push back, the market makers push back, the clients push back. But one of the things that I would like to say about the ETF ecosystem is that we will all band together. So whatever happens in the next 6 months, a year, 2 years, you'll find the group of us getting together to find a way around it to make basically the trading investing experience for clients to be the best it can be. And so I think that's one thing that that we do have inherent. And I think Joyce's role at RFQ Hub is one that's huge, because I think it still opens people's eyes to be able to say, oh, I can trade this. This is something that I can actually buy and sell and get a tight market for lower total cost of ownership. And I just want to say, Naomi may not like you, Paul, but I do.
Yeah, I would just close with we're all just trying to find better solutions and better workflows for clients, so the end investor. And that looks different for different people. I'd mentioned the two partnerships that we actually have going forward. They're very different end clients that are using those two partnerships. One is for the agency broker-dealer community, and one is for the long-only traditional asset manager. Again, so it looks different for different people, but finding better workflows so you get better execution in ETFs basically helps the entire ETF ecosystem. So I would say, just ask the questions. There's a lot of tools out there. Thank you.
Great, thanks. I think that what you mentioned, Brian, I think it really, there's a word that I'll just make up maybe, coopetition, right? And that's kind of a lot what the ETF industry has been, and it's evolved from those days when I was working back on the floor of the exchange. You had market makers working with specialists. Everyone was kind of competing, but everyone was also kind of working together to find solutions, right? And that's something it's kind of been with the ETF industry through its whole existence, right? As we've kind of, ETFs are so innovative that we've kind of worked together, even though we're competing, to kind of come up with solutions to problems and coming up with solutions to the liquidity issues, right? It's something that, new products and innovation, it's just a core of the ETF ecosystem.
Yeah, we're all really fun, too.
And I know we didn't have an exchange represented on this panel, but I think thinking about coopetition and the exchanges and the emergence of TechC as well, the exchanges, there was a panel before us, they're all developing new programs that actually make it more competitive and more incentivizing for market makers. So that is, at the end of the day, also helping the issuers immensely. And we're all competing, but, and like you said very nicely, coopetition and working together.
All right.
Great. Thanks, everyone.
Thank you, everyone.
Thank you.